Welcome back. Well, things will get a little bit volatile as we close down the weekly contract, but the stock definitely in focus is Century Enka. As we said, there's a big turnaround into the performance, and I think the doors closed out there. The stock has gone up close to 19% post its numbers, double-digit margin. See in the street likes it. Let's welcome Shiv Diwan, the Managing Director and Head Institutional Equities of Nuvama Institutional Equities, who joins us on the show. Hi, Shiv. Good to see you win. How are you feeling about the Indian markets? You know, pessimism is creeping in gradually, and the naysayers are getting a little bit louder. At times, that's not a bad time to start allocating a larger proportion of money. What's your take? Headwinds ahead, but time to buy?
Yeah, good afternoon, and thanks for having me on the show. I believe that yes, there has been some pain. Can you hear me?
Yeah.
Yeah, there definitely has been some pain that we've been going through.
Okay, all right.
Go ahead, Shiv. Go ahead.
Yeah. No, I think there has been some pain that we've been witnessing. But having said that, like you mentioned, I think valuations now for the markets in general have become a little bit better, even whether you look at it on a market cap to GDP basis or a price to earning basis, or even the relative premium to emerging markets. So to that extent, I do believe that the time is now starting to get better in terms of getting invested. Of course, I don't think anyone will probably take a top-down view as yet. It'll have to be more stock-specific, more bottom-up, that's what we are also warranting for. There are obviously certain sectors, certain stocks that we would probably prefer and suggest and recommend to clients.
Do you want to talk to us about these ideas of yours?
Sure. So, I mean, look, the valuations for some of the sectors that I'm going to mention are probably not totally compelling. But having said that, this is a market where people will pay a premium for visibility. So I believe that some of these sectors still do have a play. One is, of course, the whole power T&D space within the whole industrials pack. Despite the fact that valuations have been a little expensive, the sector still offers very, very strong visibility, and because of the fact that there is this whole renewable connectivity that we're talking about, and the whole AI data center space that these players sort of take a part in, they should do very well. The auto pack is another space that we think after a little bit of a down move in the last quarter is starting to come back. If you've seen the numbers, they've been fairly heartening. Of course, our belief is that the best way to play the auto sector is via the auto ancillary pack. So, there are multiple stocks there that you can play with, but whether it is internal combustion engines or it is EVs, I think there is a massive opportunity in that space, and valuations now are getting far more compelling. The third sector that we also like is chemicals. They are starting to now make a comeback. I think the anti-involutionary measures that China has taken has helped. Plus, there is a currency tailwind, and there is a little bit of a volume growth that we're now starting to see in some of the chemistries. So I think these are the three sectors that will definitely benefit. And then, of course, there is one sector that most people tend to discount at this point, and that's the IT sector. Our feeling is that most of the pain has been borne by the sector. Valuations now have become very, very compelling there, and I think that there is always going to be an opportunity for some of these domestic players to be system integrators for enterprises and help in the overall process, and that's where I think some of our companies in India should do very well. Having said that, it's not going to be a play for the entire sector, and you'll have to be picky in terms of which few stocks you take from that sector.
Not private sector banks. Shiv, most of the people that we speak to on the channel seem to suggest that private sector banks valuations are something we've never seen before, at least not in the last many years. Valuations here, you would say, are compelling.
I agree. I think valuations are definitely compelling. I think this is a sector that people have always liked, because of the fact that you had balance sheets which are in their best possible shape over the last few years, not just this year. It's actually been over the last 2-3 years where you've seen great balance sheets. But of course, I think with private banks, the one other aspect also to look out for is that you will need, because of the large market caps, you will also need foreign institutional participation to sort of come through, because most of the domestic institutional investors are typically heavily owned on these private banks.
Got it. Okay. All right. Shiv, what about these new age themes? There was so much of excitement about them, and some of them have just fallen by the wayside. For the time being, there's not too much excitement out there. And at times, in an environment when yields move up, discounting as well, is done at a higher rate, which obviously hurts some of these new age companies. What's your view?
So I think the one thing to keep an eye on is that yes, while these new age companies have done have done well in the past, for now our sense is that there is a little bit of pain there in terms of visibility. We've not seen that kind of visibility that we see in maybe some of the hard asset owners, or and that's a space that I think will probably trump over the new age players at the moment. I think if you talk to investors, clients, I mean, they will tell you that today in India, what is starting to look far more interesting is the asset owners. So whether it's ports, airports, cement, utilities, these are some of the spaces that people would like to look at. We ourselves are far more constructive on that space currently, rather than the new age place. I think that time will come, but maybe a few quarters out.
Shiv, I know in the last 1.5, now nearly 2 years, at the index level, we haven't done too much, but there have been so many opportunities to make money. So I guess that continues, and you've highlighted some of the themes that you like. But at an index level, because many people just invest via the SIP in a Nifty ETF equivalent, what should they expect? What is your own assessment for the next 6 to 12 months? Do you see the markets giving returns?
Tough call there, but I would say that look, valuations are definitely compelling. There will be some stocks, and some sectors within the Nifty 50 or the Sensex 30, whatever you look at, which will sort of deliver for the sort of index. But there are also others which will probably play laggard. So to my mind, over the next 2 to 3 quarters, I think there could be some sort of sideways movement. But I believe that now the likelihood of positive bias is more so than a negative one. And of course, if the geopolitical situation improves, then you could probably see a little bit of an impetus, starting up and then sort of plateauing out.
Shiv, what about this Indian rupee fall? It's definitely hurting sentiment, but people are trying to find winners. What is your view first with regard to the rupee? If we see some stability, if we see a couple of measures that help the rupee, how positive would it be? Point number one. Point number two is, have you managed to find any winners? You already told us about tech, and we'll see how that one plays out. But any other sectors that could be better placed because of the depreciation we have seen on the rupee?
So first of all, yes, I think rupee the rupee depreciation has definitely hurt the raw material part of most companies, and obviously if that were to correct itself, then that things could get much better for some of these sectors, whether it's consumer or pharma or or even maybe chemicals. Now, on the other hand, like I mentioned earlier, that chemicals, the exporters within the chemicals pack should definitely be beneficiaries. I think certain pharmaceutical names could also sort of benefit if the rupee were to start improving. And this pain has also resulted in the fact, for most foreign institutional investors, just by virtue of holding on to their current investments, that's hurt them a little bit, right? Because of the rupee fall. And if the rupee fall, it does get arrested and things start to get better, I suspect that you should start to see some of them starting to come back. And that overall should help sentiment as well. So I think there is an overarching theme as well that could play out if with rupee fall were to get arrested.
How are you hedging yourself, Shiv, if this war lingers on longer? It's been 12 weeks already. There's still no resolution in sight. We've had multiple false starts where our hopes have been raised only to be dashed one day later with a post on Truth Social. So if this war lingers on, how are you hedging this portfolio?
So the one sector that we didn't speak about, and which is obviously a sector that has been a bellwether for a lot of the domestic funds and for a lot of the players here, has been FMCG. I think you've always seen volume growth that has been heartening, but for the first time out, now we are starting to see a little bit of pricing growth coming back, and that should definitely benefit the sector, and also given the fact that it is one of those sectors which is not too volatile, which will continue to see consumption growth slow and steady at a pace that we like. So that's one sector that we definitely want to be in. And the domestic consumption story, whether it is auto lines like I mentioned, or even the cement plays, which will sort of start to come back, are the sectors that we think we would like. Obviously, I won't mention individual stocks, but these are the sectors that we think someone could stay invested in. And if we get a solution to the war, then of course then there is a broader base to play on.
Got it. Okay. All right. Thanks, Shiv. Wishing you a good remainder of the day, and we catch up soon. Thanks for giving us some of your thoughts on the markets as well as individual sectors. By the way, let's do a quick check on the F&O market, then the advanced decline ratio first. That's heartening to see.